Is mutual fund NFO a profitable investment? Come, let's find out through a detailed analysis in this video. So what is a mutual fund NFO? Mutual fund NFO is new fund offer. When an asset management company launches a new mutual fund scheme, it gives a first time subscription offer and it is called mutual fund NFO. This mutual fund NFO is open only for a limited time period. Then it closes and again reopens. When you are investing in NFO, three important dates are very crucial. The opening and closing date of NFO. So if you invest between the opening date and the closing date of the NFO, then you would invest for the face value of 10 rupees. The third is reopening date. If you are investing after the reopening date, it is called as the subscription reopening date. If you invest in that date, you can buy or sell only in the current NAV price of the market. Should you invest in NFO or not? But before that, if you wish to invest in NFO, what are the factors that you should look into? First, you should do a background check on that particular mutual fund company or fund house. Second, you should consider the investment objective of the particular mutual fund scheme. The third is that you should consider the risk profile of that particular fund and whether that risk profile matches with your risk appetite. Next, you should analyze what kind of investment time horizon that particular fund is suitable for. If it's an equity fund, it requires 5 to 7 year time frame. If it's a debt fund, 1 to 2 years is enough. So you should check whether your individual investment time horizon and the fund's investment time horizon is matching. And you should also be aware of the minimum subscription amount. You should also check which category or theme this NFO comes under and what is the benchmark index of that particular NFO. Only when you evaluate all these factors, you would get a 360-degree perspective of the NFO. Okay, now, should you invest in NFO or not? Is NFO profitable or not? Whether an NFO helps you earn profit or generate loss, it depends on the scheme that you are looking to invest. It also depends how that scheme might perform in the future. But is it necessary for an investor to invest in an NFO? In my opinion, no. Why I am saying this is because there are already good funds with a good track record in the market. You should compare this already existing funds to an NFO to understand in what factors they score more or less. The first thing is that NFOs don't have a performance history. As there is no performance history, we cannot calculate or make a judgment based on how this fund has performed in the past and how this fund will perform in the future. Existing funds already have a portfolio, but since NFO is a new fund, it has to collect funds from investors and look to create a portfolio. As they don't have a portfolio, we are unaware what kind of stocks they are looking to invest or what sector they will give more weightage. When we are not aware of such factors, then the risk that we are going to take is not a calculated risk but a blind risk. This is why we should look to invest in existing funds with a portfolio and a track record. Investing in NFO is like doing a health checkup in a newly opened clinic or sending your children to a newly opened school. While investing in an existing fund is like choosing a hospital or school with a proven track record. Another important thing is that the expense ratio in an NFO is not decided. The range of expense ratio will be within the prescribed range of SEBI, but still an investor would not have a clear idea of what is the exact expense ratio in an NFO. Whereas in existing funds, you will have a clarity on the actual expense ratio. So when an investor is investing in existing funds, he is able to make a more informed decision. Many investors think that in NFO I am able to buy at an NAV of 10 rupees. So I am purchasing at a cheap price with more units. No, this is a misconception. Suppose an investor invests 10,000 in an NFO, he will have the potential to buy 1000 units at a base price of 10 rupees. Suppose the same investor invests in an existing fund and the value of a unit is 20 rupees, then he will be able to purchase only 500 units. Suppose the investor invests in another existing fund which has a price value of 100 rupees, then he will be able to purchase only 100 units. But we think that we are getting more profit in NFO because we are purchasing more units. But that is not the truth. This is like the difference between 1 gram, 2 gram and 10 gram gold coins. If you purchase a 10 gram gold coin, you will have 1 coin with you. Suppose if you purchase 10 1 gram coins, you will have 10 coins with you. It doesn't really matter whether you have 10 coins or 1 coin. In the end, only the total value matters. In the similar way, NAV is just a denomination. Suppose if you are going to withdraw 10,000 rupees from a bank, if you want it as 10 rupee notes, the number of notes will be higher. If it is 100 rupee note, then it will be lesser. If you want it as 500 rupees note, the number of notes will be even much lesser. But just because the number of notes is lesser doesn't indicate that the actual value is lesser, right? In the similar way, the number of units being on the higher side or lower side does not carry much importance. Also, whether the NAV is higher or lower when buying or selling does not matter. But what should be investors' concern is that what rate does the underlying portfolio appreciate? How is the portfolio looking and how is the fund manager's track record? And what is the performance the fund has been delivering so far? If the underlying portfolio generates 10% return, then irrespective of the NAV value, if it is a 10 rupee NAV, then it would have raised to 11 rupees NAV. If it is a 20 rupee NAV, then it would have raised to 22 rupees NAV. And 100 rupees NAV would have raised to 110 rupees. So if you have invested 10,000, wherever it may be, it would become 11,000. We should understand that the underlying portfolio and the fund manager track record carries more importance than whether the NAV is 10 rupees, 20 rupees or 100 rupees. This is a big misconception in NFO. Many investors invest in NFO for the 10 rupee NAV value. You should understand that this is a trap and don't fall into this pitfall. By choosing funds with good track record and existing portfolio, we are able to take a calculated risk. So it is always advisable for investors to choose existing funds rather than NFO. So what kind of existing fund should you choose? Or which fund has better risk adjusted returns? If you want answers for these questions, then you should consult a professional financial planner or a mutual fund distributor. Existing funds or NFOs, what is your preference? Please mention in the comment section. I will meet you with another interesting video. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.